Hello and welcome to Grain Shark's Survival Guide to Marketing, a new video series focusing on all the day-to-day tools and tricks you can use to help better understand the trends in the markets. Overall, what it boils down to is how do you build a better marketing plan and how can you make more money for your farm? In this episode, we're going to be looking at some of the very introductory information about charts. This involves how we get the futures charts set up the best way to follow along with the markets day to day. So let's get started. First off, futures markets can be shown over various lengths of time. So we're going to be using daily charts to help with short-term forecasts, and then we're going to be using weekly and monthly charts to help us with the long-term forecasts. Every day we have an opening price. That market trades a range, giving us a low and a high, and then we finish off with the closing price. This information is very important because it's going to give us different buy and sell indicators throughout the year. There's a few types of charts that I follow. Bar charts and candlestick charts are the most common because they do give us the clearest picture of the market. There's many different ways that we can view the markets. All we have to do is play around with the chart settings. And then finally, charts are mainly used to find trends, ranges, and reversals. So here's what a futures chart looks like. At the very top, we have the type of chart that we're looking at in this example. It's a daily canola contract. Directly below that, this is the important info, the meat of the market. This is our pricing data. And then right below that, we can look at all the different chart settings we can use to change the chart to the way that you want it to look. So what's a bar chart? Well, bar charts start out with a left tick on the bar. That's an opening price for the day. The market trades its range, giving us a low and a high, and that builds a range. And then we have a right tick on that bar, which is our closing price. In this example, we've closed higher on the day, so that's a good day. The opposite, we have our left tick, which is our opening price. The market again trades a range throughout the day, giving us a high and a low. And then the right tick is our closing price. Because we've closed lower on the day, that's a bad day. Candlestick charts are very similar to bar charts. The only difference is that open and closing price are filled in with a box. So when we have a white box, or a green box, depending on what type of candlesticks you're looking at, that's a good day. And then the opposite is when we have that open and close filled in with a black box or a red box. That means we closed lower on the day, so that's a bad day. There's many different types of charts we can be using. Bar charts, line charts, candlestick charts. There's two types of candlestick charts. You can cycle through these using these chart settings here. What chart you choose depends on what type of information that you're looking for. Here's an example of a bar chart. So we can see that our left tick, and then we trade a range, and then that right tick is our closing price. That's a bar chart. Here's what a line chart looks like. Exact same pricing information, except we don't see the open, close, low, and high for the day. So this gives us kind of a view of what the actual trend of the market is. It's not going to help us with determining when those buy and sell indicators are showing up, but more so just showing us that, hey, this market's in a downtrend, or maybe we're trading in a sideways range. Candlestick charts, as mentioned before, the black box means the market closed lower, and the white box means that we closed higher. And we can also add some color. This is all personal preference. If you can see things clearer with red and green versus black and white, then you can use the candlesticks with color. There's also different chart periods we can choose. This is going to help us with forecasting for short-term and long-term. For grain forecasts specifically, we're most often going to be looking at the daily, weekly, and monthly contracts. We could go back and look at 60-minute charts or even as quick as a 5-minute chart, but that's a lot of information to be taking in, especially when you're not making grain sales specifically every 5 and 10 minutes. You're making grain sales over periods of days, weeks, or months. So our daily chart, each bar or candle represents 1 day of trade. So with the bar chart, this is what a bad day looks like. We had a big move lower, and then here's a good day where we have a nice move higher on the day. Candlestick shows the exact same information. We had a big black down day followed by a good white day up. And then our colorful candle, red is down, green is up. So same pricing information, just different views of a daily chart. Our weekly chart, each bar or candle represents one full week of trade. So this is a really strong week. We opened here and then the market had a big move up and then closed way higher on the week. That's a good week. A bad week is where we've closed lower, of course. The candlestick version of that, a big white box higher, that's a good week. A black box lower is a bad week. And add some color if we have that green box higher, that's a good week. And a red box lower is a bad week. Our monthly chart is going to be our longest term trend. It's going to give us a look at the market over a period of months. Each bar or candle on this chart represents 1 month of trade. So we can see there was a really bad month here where the market moved lower, and then we've had some times where there's been good months where the markets move higher. And again, we can look at those differently when we're looking at the hollow candlestick or the colorful candlestick charts. Density settings are important. They can change how much data is shown on the charts. Choosing a higher density is going to give you a bigger picture, show you more data, but it's also going to make it harder to look for buy and sell signals. So we can choose between low, medium, high, and maximum density. So let's take a look at what those would look like. So here's a low density chart. This is showing us not very much information because the picture is bigger. We're looking at only about a month's worth of trading data, so we're not getting a lot of information from this. Let's move ahead to the medium. This is the density that I like to use. We're into that 3-4 months range where we're seeing a good kind of picture of what the market's been doing over a certain period of months. Then we get into our high density, and this becomes a little bit less clear because now we can't actually see where those markets opened and closed compared to previous days. So we're now not able to see any of those buy and sell indicators showing up. So high density is good to see bigger trends, but it's not so good for honing in on those actual buy and sell indicators. And then we have our maximum density, which is even further out, and you can see it goes so far in a daily contract that contract itself wasn't hardly even trading, and that's what all these dots are representing. Very thin market trade. So try to stick with your medium density. Sometimes you're going to use high density, but very, very rarely will you actually want to go and look at your low and maximum density on the charts. You can also toggle your volume and open interest on or off. This depends how much faith you have in the volume and open interest indicators. Volume is the number of shares or contracts traded. So every transaction in that market is going to have one buyer and one seller, and that contract is going to contribute to the total volume. And then we have open interest, which is the total number of outstanding contracts that are held by the traders at the end of the day. When we have volume and open interest turned on the chart, you'll see at the very bottom, our green volume bars are shown when the market has closed higher on the day. So each bar is representing how much volume there was in the market and whether we had a strong move up or a move lower for that day. The red volume bars are shown when the market closed lower on the day. And then this purple line is going to represent the total open interest for that market. So following volume and open interest is important down the road because there's definitely some good buy and sell indications you can get from following both these indicators. We'll touch base on that in a few episodes down the road because that is something that's a little bit more detailed to cover. You can also compare markets to markets. This is very important. This will help give indication of some other trends that can occur. So basically, you're going to type in the contract that you're interested in looking at, followed by typing in the commodity that you want to compare it to. So here's just a couple examples. This one's comparing the canola contract to the current soybean market. And we can see that canola and soybeans will follow a similar path. Not all the time, but this purple line is the current soybean market, and the black line is our canola pricing. You can see that they're trading sideways together, and then when soybeans started to drop, so did canola. Until recently, we've seen soybean prices have been moving higher, while canola has been staying more sideways. So let's find out why that is. We can compare the canola market to the Canadian dollar. We see when the Canadian dollar, the purple line, is flat, that canola market isn't reacting too much. But as soon as we start to see some upside in that Canadian dollar, then this canola price starts to move lower. So canola price is weighed on by the Canadian dollar rising, and that's why when we have the soybeans moving up, canola is not moving up to the same extent that the soybeans are. This is all because of the relationship with exports and the Canadian dollar. The stronger the dollar is, the less interest there is in world markets coming in to buy canola. You can also mimic the chart by changing grids and the size of the chart. This isn't really that important to cover, but you can turn that on or off depending on your visual preference. I like to have the grids off and have a small chart because then you can really see what the chart information is showing you. The grids can kind of muddy up the picture, so I like to turn them off. In summary, daily charts, they're great for short-term forecasts. You're going to use daily charts when you're trying to figure out what you need to be doing for the next period of days in that market. Your weekly and monthly charts are going to be used for the longer-term forecast. So if you have no reason to be selling in the short term and the forecast is higher for the longer term, you can use those weekly and monthly charts to determine what the trends are and where you should be setting your targets. The open, close, high, and low is very important to follow day to day. We'll get into that in a future episode when we cover off reversals patterns. The open, close, and high and low will give you some very important data that you're going to want to be keeping track of. Choosing a higher density may result in missing a signal, so go ahead and make sure you are sticking in that kind of medium density, sometimes into the higher end, but medium density is where you're getting the best picture. Volume and open interest are important. You don't necessarily have to have them on the chart every time. I take them off a lot of the times when I'm looking at strictly what the markets, what the open, close, high, and low data is telling me. But when it's important, the volume and open interest can give us buy and sell signals. And then we can compare markets to bring more trends to your attention, such as the correlation between oilseeds, soybeans, and canola, and what pressures the canola market outside of just general supply and demand for that market. So that's it for now. Stay tuned for our next episode where we'll be diving a little deeper into the world of chart analysis and look at how to find trends and ranges for the markets. This will kind of be the start of where we learn when it's time to start watching closely for buy and sell signals and where we can be setting targets to maximize the price on each sale that you have made. Also, if you have any questions about the info we just covered or want to learn more about GrainShark, you can shoot me a text at any time. My number is 204-299-0433, or you can visit us at our website at grainshark.com.